How you doing, Mike? Everything good?
Doing good over here.
Yeah. Markets are up
Beautiful,
past
cold
2
rainy
days.
day. Yeah.
I
Yeah.
couldn't complain. So, all right. Well, we always start these things on time and we end them on time. We're going to share this with all our beloved clients and prospective clients. So feel free to share this when we do so after. And if there's anything you missed, don't hesitate. As always, the format will be, we'll keep it 30 minutes. Mike's going to speak, who's our chief investment officer, for about 20. I'll field any questions. Feel free to just write them in and I'll ask them directly to Mike. But with that said, good afternoon and welcome to our next quarterly market and economic update. Certainly a lot going on in the past 3 quarters. I'm Andrew Rosen, president of Diversified and also one of the planners. As we begin, and we've been accustomed to do every quarter, this webinar is designed to give our clients a recap of the last 3 months in the markets and our outlook moving forward. The expectation is that we'll have, like I said, 15 to 20 minutes of prepared remarks, and then we'll turn it over Q&A for up to 10 minutes if we need it. If you don't have questions, then don't worry. And if you do, type them in and I'll ask them at the appropriate time. So with that said, the man, the myth, the legend, Mike Horwath, our own Chief Investment Officer at Diversified. Why don't you educate us and inform us, Mike?
I'll do my best.
Thank you.
So thank you. Appreciate it. Thanks for hopping on, everybody. As Andrew said, my name is Mike Horwath, the Chief Investment Officer here at Diversified. We started this quarterly update not too many quarters ago, but the whole idea is it's supposed to be and designed to be just a comprehensive update for all of our clients and just to really recap what's going on, right? Good, bad, or indifferent. Well, what's happening in markets? What's happening within the economy? How are we positioned in portfolios? What's driving markets? And then also make sure that it's a good forum for anybody with questions. That certainly feel free to pass those over, and we'll be happy to go through them. A lot going on, right? So I think we'll jump right on into it. The story has remained the same, right? The story is still inflation, right? Inflation remains elevated, both headline inflation, right? Headline inflation is pretty much all items in the basket. So call it the consumer price index, a basket of goods and services. All of them included would be called headline inflation. And then core CPI is when you strip out energy and you strip out food, right? Those are 2 very volatile areas, sometimes less indicative of the inflationary environment. But both have consistently remained elevated, and the Fed is entirely focused on fighting it. So if you recall back to February, so February put out a video about what the Fed even is, who the Federal Reserve members are, what their job is. And if you recall, they have what's called the dual mandate. So the dual mandate means they are trying to balance 2 things. They're trying to keep stable prices. Really what that means is low positive inflation, call it 2-ish% is their target, and full employment. Or another way to say that would be low unemployment. So they're trying to balance these 2 things. We'll talk about it in a second. Unemployment remains very, very strong, but prices have not been stable. We have consistently seen CPI headline above 8% over the last several months. We've seen core inflation remain above 6% on a year-over-year basis for the last several months, way above their 2% target. So what does that mean? That entirely means that they have to try with what limited tools they have to bring down inflation via rising interest rates. So they can manipulate markets a little bit via short-term interest rate mechanisms, right? So by raising interest rates, their objective is to slow the economy. By dropping interest rates, they'll be more accommodative and look to stimulate the economy. You think back to March 2020, what they do, interest rates went back to the floor. Coming out of the great financial crisis, what did interest rates do? They went to the floor, stimulating the economy, making things very easy, much more affordable for debt. On the flip side, when inflation tends to run hot, when the economy is very, very strong, they have to go the opposite way. They have become very restrictive. And in order to do that, they have to raise interest rates. Makes the cost of borrowing higher, slows the economy typically. The hope from the market has been that inflation would peak and come down meaningfully before the Fed would have to go quicker and quicker and quicker. The rhetoric from the Fed, though, has been clear that their focus is raising rates and bringing down inflation. And it seems at this point that rates are going to remain higher for longer. Their entire intention is to slow consumer spending, which is essentially demand. And as part of that, the question remains, what's going to happen to GDP growth? So you see on the right-hand side of this is real GDP since 2001. You can say, the US has kind of settled into this trend growth, if you will, of about 2% per year. Some years, we're above that. Some years we're below that. But over the last, call it 2 decades or so, we've had trend growth of about 2%. COVID obviously pulled things back. We've worked our way back to that. Our expectation, though, is that after multiple quarters, especially in 2021, of very, very strong economic growth, the Fed has no choice but to slow that. Now, does that mean recession? I think that's up for debate. I think it would be wise to plan for a recessionary environment. Don't think it's going to be extreme by any stretch of the imagination. I don't think you're looking at a 2008 scenario, but they have to slow the economy. As part of that, they have to slow consumer spending, and it's likely that there will be a little bit of damage to the economy. This is what the market is pricing in already, so that's important to remember. But you can see that the market has settled in around a 2% economic growth trajectory, and the question now becomes is what damage does the Fed have to do in order to get inflation down? And what the market's really looking forward to at this point and looking towards is the signs that the Fed is going to pivot from raising rates to stopping their rate hiking cycle, and then potentially even kind of pulling back. Do they go too far and that they need to cut rates once inflation does pull back? So that's all that's happened this year. There's been a lot going on. And naturally, the biggest concern for investors has been looking at account balances on a daily basis, right? People lose their minds doing that because you deal with the fluctuations in the market. But through the end of the third quarter, global equity markets were down about 25, almost 26% on a year-to-date basis. The bigger concern for most investors has been the bond side, right? So bonds have always traditionally been a great hedge against equity market risk. This year, the issue is what's affecting the stock market is also affecting the bond market, right? So when economic conditions worsen, you think 2008, investors often flock to fixed income, to bonds, to debt, which is more stable, is higher in the capital structure. So bonds have less risk than stocks do. This year, rising rates has not only affected the bond market because higher rates brings down the prices of bonds. The stock market is valued and stocks are valued using interest rates. So higher interest rates means higher discount rates, and that means the value today is less than if the interest rates were lower. So we'll talk about that in a second, but the issue with the stock market is the same issue that's been with the bond market. So for the last 9 months, we've seen this volatility. So this is what investors have dealt with. This is what they've had to fight through. The good news is that a lot of pessimism has been built in. A lot of this extreme tightening from the Fed is built in. What's been tough for investors to stomach is just the length of this. If you think back to COVID, peak to trough was a February 19th to March 23rd of 2020. We saw 35% peak to trough drop. It was easier to stomach in the sense that it happened in 5 weeks, 4 to 5 weeks. This has been 9, 10, 11 months of this transition to a Fed raising rates. And think about it, coming into the year, the Fed thought they were going to raise rates and said that they were going to raise rates, likely 3 times, 0.25% each time. That has not happened remotely close to actuality this year. We've seen them raise rates 75 basis points on multiple occasions. Expectation would be that they're going to continue raising rates in November and December. At that point is when they'll likely start to really pause and understand what's happening, where's inflation, what kind of damage, if any, to the economic environment have they had to go through. But this is what we've looked at from an investment standpoint. There hasn't been really many places to hide, right? From bonds to stocks, and even within stocks, domestic, international, large, small. it's been widespread repricing because of what the Fed has had to do. This is the entire story, right? You can see where this pivots coming out of 2020, going into 2021, into mid 2021. Not only has inflation moved up, the issue has been it's now been persistently high for several months at this point. We're seeing 8.3 on the headline, right? As a reminder, headline is including energy and food. Core strips those out, but both are remaining elevated. So even with energy prices coming down, for example, that helps headline inflation, but you still see that core inflation remains elevated, which tells you that the inflationary environment is more widespread, right? You're seeing more service, elevated prices, right? You're seeing goods outside of commodities and things like that remain elevated. Those are the items that are going to need to turn the corner and peak and come down meaningfully and give the Fed confidence that they can go ahead and begin pausing and maybe even looking at cutting rates at some point. This is the interesting part. This is almost the conundrum that the Fed is in. So this is a busy slide, so let me unpack it for you real quick. On the left-hand side, this is the labor market. The top would be total non-farm payroll, so people that are employed. And the bottom is almost essentially an inverse. That is the unemployment rate. As you would expect, they would pretty much be inverses of each other. What we've seen is a recovery from those troughs of peak COVID times, right? April and May of 2020, to a very strong labor market where unemployment's now at 3.7. It was around 3.5, 3.6%, a very tight labor market, which is great. Here's the problem. On the right-hand side, you see that there's 1.87, so nearly 2 job openings for every one person looking for a job. That type of labor market requires employers to spend more money on their on prospective employees. Wage growth picks up, and look, when wage growth picks up, people have money, they're willing to spend more when prices are elevated. So we have all of this confluence of events from a supply issue with COVID and supply chains and all of those things from that aspect. But then you also have people who are working, a strong labor market, and wage growth that has been pretty high. So all of this has come together to a point where the Fed needs to raise rates to make it a little bit of a more normal environment and slow down consumer spending. This has been the story of the year, right? Coming into the year, we had a slightly positive, much lower interest rate curve. And a mere 9 months later, we're looking at short-term rates and short-term bond yields above 4%. Things have changed so drastically, and they've really done so throughout the year, right? The Fed has set expectations where they'll raise rates, but they felt very confident that inflation was peaking. And as inflation has remained persistently stubborn, they've reset those expectations. And this is where you saw, we saw that bounce earlier this year. And then we proceeded to see July, August, that time frame, markets kind of pulled back because all of a sudden it was a resetting of expectations that the Fed was concerned that the market was getting ahead of itself, that they were going to be able to slow down their interest rate hiking cycle. So this has been the story this year. This is the story in bond markets. This is the story in the stock market. You know, we talk a lot about consumer spending. We talk a lot about corporate earnings. But the reality is that the market volatility on the equity side and the bond side has been driven by the Fed raising rates and higher rates throughout the year. And I think a good way to look at it is via this slide, right? The source of the volatility. So if you think about how the stock market's valued, you think about, you have corporate earnings, you have what's called an equity risk premium, which we don't have to talk about. But then we also have what are discount rates, which are just what value for short-term interest rates or interest rates that you can use to value future cash flows. A company makes money, they have earnings out into the future, and you project what those are valued at today. What you see is the gray bar shows earnings growth hasn't changed, right? Expectations around corporate earnings haven't really moved at all. So we can sit here and say that consumers are very strong or consumer spending is going to slow. But when it comes to valuing the market, earnings forecasts haven't really changed. They haven't really moved. The entire reduction in the market this year has been driven by what's called multiple compression. What that means is that as interest rates rise, the multiple that people are willing to spend on a company decreases. That has been the entire issue this year, is that when interest rates are at the floor where they were, you saw price to earnings ratios on the stock market at 21, 22 times earnings. Today, you see a valuation around 15 to 16 times earnings. So rising rates has caused those multiples to compress. It's not because all of a sudden the market's pricing in that Apple can't sell any more iPhones. No, they're pricing in that the discount rate we're using for future cash flows is now much higher than what it was 9 months ago. And that has been the entire cause of this repricing that we've seen for the last 9 months. The focus will now be on, where does the Fed go? Does the Fed look at cutting rates at some point here to bring that discount rate back down? What happens to corporate earnings? What happens to profit margins? These are all the things that we're looking at, talking about internally, how that's going to affect ultimately what we believe the path is moving forward. But I think this is an important perspective on what's happened in the equity market this year. With everything that's happened, though, it's also important to keep in perspective why you own equities. Equities have always been and always will be the long-term driver of returns in your portfolio. They are volatile in the short term, always. Over the longer term, though, they have proven over the last 2 centuries to be one of the best hedges against inflation, best sources of growth. The real return, right? If you think about the inflation adjusted return of the stock market relative to bonds, to gold, to cash, vastly superior, right? You are compensated for the risk you take over time. The key is over time. In order to get back to the peak, you see on the right-hand side, market peaked around 4,800 on the S&P 500, what the return would need to be over a 1 year, 2 year, et cetera, year period. Those gray bars are what the annualized return would need to be. So you can see that, look at, if we keep a longer term perspective, the annualized return we would need over a 2, 3, 4 year period after coming off of a period of this big drawdown is not overly unreasonable, right? The hard part is to sit back and say, well, what the markets have done, global markets down 25, 26% year to date. How do I get that back ASAP? It won't happen ASAP. We've seen a couple straight good days. That's great. But we're going to want to see this over time, right? It still matters that we own equities over time to be the source of our long-term growth and our inflation adjusted growth within our portfolio. So the key is to not panic, to not lose focus of why we own equities, and just remember what needs to happen to get us back to where markets peaked, 9 months ago. I think it's also an interesting point to jump into the bond market. Bonds have gone through a really unprecedented event, at least in the last 40, 50 years this year, right? Rising rates and how quickly they have risen has hit long-term government bonds by far the worst, but even shorter term bonds have been hit quite hard. What you're looking at, though, is the aggregate bond yield. So the Bloomberg Ag is the index that we use for the US bond market. It's the most popular index. This is the yield on that index. And what you saw was a pretty challenging environment for bond investors over the last, call it 8, 9 years. You saw bond yield. So your bond portfolio, at least the bond index in the US, was yielding, right? The income yield that you would get off of it, 2.5%. You saw a little bit of a peak above 3% there. As most recently as 2020 and 2021, we were in the mid ones on a income yield basis for your bond portfolio. The best predictor of your future return in bonds is this bond yield. And despite the short-term pain that's come from rising rates, as an entry point for bonds, they are substantially more attractive today than they were a year, 2 years ago. We're seeing bond yields that we haven't seen in over 10 years. And we're also seeing an environment where default rates remain very low, corporate balance sheets are very strong. Once again, this has been driven by just rates and rate expectations moving up so quickly. But as an entry point, as a point to buy into fixed income, retirees, especially who need more income and need more diversification and stability, it is a good buying opportunity within the bond market today, especially relative to where it was 1-2 years ago. So where do we go from here? So from an outlook perspective, our focus is on what happens to corporate earnings, what happens to consumer spending. You've heard me repeat it a million times. 70% of US GDP is consumer spending. What happens with it with rising rates? What happens to corporate earnings? Profit margins have been extremely strong for corporations. We anticipate that that's going to have to narrow a little bit. And in the end, inflation is going to drive everything. If we woke up tomorrow and inflation dropped to 2%, the Fed is cutting rates. The key is how quickly and when does inflation come down? So that will be the ultimate determination. That's what we're keeping our eye on. The bond market has priced in these interest rate hikes. It has been painful for especially long-term bond investors. You think about insurance companies and things like that that have had to deal with some of the price movement, for investors who own a ton of fixed income. But it is a substantially better entry point today than what it was a year or two ago. Markets hate uncertainty. And what we have seen this year has been nothing but policy uncertainty from the Fed. And that's going to have to be a big part of getting clarity for things to settle moving forward.
Mike, I have a question or two here.
Go for it.
So, question from the crowd says, news today has CEO saying recession is coming and won't be trivial. They will start to act accordingly. Do you agree? What is likely result of their likely actions on returns?
Yeah. So I think, so let's caveat this. The Fed has never been able to successfully get inflation from its peak back down to their target without inducing a recession. I think the odds is that Q4, Q1, so Q4 this year, Q1 next year, a recession that would be likely. Now, a recession is not just simply 2 negative GDP quarters. You have to see a meaningful decline in consumer spending, in employment. So we would see unemployment pick up. The Fed's already anticipated that unemployment will have to increase just to slow this thing down. So our anticipation would be that a recession is now more likely than it is not. You're going to see CEOs have that a perspective, right? They're coming at it from, they're going to likely have to lay off people. They're trying to do some PR damage control. But I think also reality is, and to probably your point of consumer spending has to slow. The Fed is literally trying to slow spending and slow things down. We have to know that. So it is likely that, to me, there will probably be a recession. We'll probably see unemployment tick up a little bit, although the labor market will remain pretty strong. It's not going to 8% unemployment, but we tick up around 4.1, 4.2 would be kind of that anticipation. This is what pretty much our focus is, and we'll talk about it in a second, but from a positioning standpoint, we have become more defensive throughout this year. And many of you probably saw some communications not too long ago about becoming more and more defensive, just because we want to protect our downside a little bit more until we have clarity around what the consumer side looks like and what the earnings outlook looks like. In a typical recession, earnings expectations come down, call it 5-10%. We haven't seen that yet. And we think if that does happen, which will be pretty normal, right? And it's normal for what the Fed has to do for it to happen, that we want to just be more defensive. And then what we're going to need to do is, on the other side of it, this is what makes being so proactive important, is we need to ratchet back up the risk. And it's likely not going to feel extremely good when we do it, but we're going to have to increase some of the risk in our portfolio and turn away from some of that defensive positioning as we start to see the other side of this light come through.
Yeah, and I know you always talk, Mike, about the fact that markets are 6 months or so forward looking. I was even looking at some charts this morning as I was writing my blog for next week and talking about how markets start to rebound before you're out of a recession. You see it similarly?
Similarly, absolutely, right? Markets are not going to wait until Q1 GDP print comes out to look to price things in. That, you know, in all honesty, whether or not we have a recession is mostly irrelevant, kind of in my mind, in the sense that the market is valued on earnings, it's valued on spending, it's valued on interest rates. Those variables matter. Now, it's all intertwined with a recession and what could potentially happen there, right? But just because there's a recession doesn't mean we're then going to go more and more defensive. We're trying to always look out what's happening to earnings. It's probably likely that we do have a shallow recession here, Q4, Q1. That's what we're seeing from most of our projections of a slight recession. But we're going to also need to see other things beyond GDP pulling back. We're going to need to see unemployment actually move up, maybe consumer spending slowing. But markets are going to be way ahead of that at this point. That's why, you know, people always say, well, why would you own bonds if the Fed's going to raise rates in November and December? It's like, well, no. They've already priced that in. That's been priced in for weeks at this point. That's what the market doesn't wait for the Fed to raise rates in November, wait to raise rates in December. They price the likelihood in, and then what they do is they move from there if their expectations were wrong. So,
okay, so we have time for two more questions, which I have queued up here from the crowd. So one is the United Nations warning that the world is on the brink of a recession. How does this statement mesh with your insightful comments this morning?
Yeah, I think it all lines up. Inflation is not a U.S. problem. Growth is not a U.S. problem. It is a global issue. Europe, in our opinion, is in one of the more difficult positions, right? They've made some policy decisions, and Europe's kind of gotten fractured between, you know, the UK and the Eurozone, but then reliance on Russian oil and trying to go through winter and figure out the cost of gas and everything along those lines. We look at Europe as an area that's certainly going to run into a challenge, and all but certainly go into a recessionary environment. From a global perspective, it is likely that we are going to face a global recession. Even in the US, we would anticipate probably the same thing, right? To a lesser extent. This is why we've seen the US dollar remain very strong and even get stronger. This is why we're overweight US substantially in our portfolios. We just look at the US as still the strength of the global economy, still reasonably valued. And with the US dollar as strong as it is, we would prefer to be here in the US. So it does mesh. We would anticipate that the global environment mirrors much of what we'd expect in the US. And really, honestly, what happens outside of our borders is probably more concerning to us. And that's why we are so underweight that international space, because we're going to need to see, you know, the Eurozone and some of those big developed nations really come on the other side of this thing. And we have a hard time seeing some of the emerging markets really taking off like China until the US dollar really kind of comes back to a more reasonable level.
All right, ready for a quick hit? Last question. From a GEP political standpoint, with U.S. spending billions to support Ukraine, and if they continue, what will be the effect of the spending to the markets?
I think that the spending to Ukraine, I wouldn't look at that as a problem, right? I think the challenge has been is we run fiscal deficits as a nation for the better part of 25, 30 years. When's the last time we had a fiscal surplus? It's been a long time, in the 90s. We have run fiscal deficits for a long time. I don't look at the Ukraine situation as necessarily an issue. I think it as a percent of what our GDP is, it's not going to be very effective. But I think the entire fiscal landscape, right? At some point, Social Security and Medicare have to be addressed. You know, there's going to be issues there. We haven't balanced the budget in a very long time. When you run consistent deficits like this, what we would anticipate at some point is that the US dollar will depreciate, right? The US dollar will likely depreciate. And in that scenario, we will likely be owning more international equities relative to what we would own today. But in the short term, I don't look at the spending in Ukraine to naturally affect much here from an economic perspective. I look at the fiscal policy that we've had for literally it's 25, 30 years, right? It's not under any one administration as the natural concern. Like, if you run deficits consistently, there are economic ramifications at some point, likely to be a weaker US dollar. The other part of this is, though, there aren't many countries that are running, fiscal surpluses at this point. Most countries are running fiscal deficits, so it's less of an impact from my perspective.
Okay, great. So thank you, Mike, for your insight as always. For those that missed it or want to share this, like I said, we're going to send it around later. Also, for your calendar, November 10th is our Market Insight event that everyone is invited to. Check our website, check emails. We're sending out invites where we have a couple investment professionals coming and experts to talk about what's going on and how they see this choppy markets. But of course, stay the course. We're here to support you. Mike, thanks for sharing your intellect. Always impressive, and we appreciate everyone. So stay well, and we will talk soon. Bye.
Take care.